Nobody is saying it out loud, so I will. Silver just got hit with a volatility reading of 115. The CME's Silver Volatility Index didn't rise, it detonated. And at the exact same time, US stocks erased roughly $600 billion in minutes, then turned around and pumped even more back in the very same session. Something snapped inside the machine. This isn't a normal pullback. This is what forced liquidation looks like when leverage meets a margin clerk, and the only thing that matters is cash. I'm your host, and today we're going to break down the fingerprints of a liquidity event. What moved, what didn't, and why the options market is screaming louder at $73 silver than it did near $120. And before we go any deeper, if you want the next breakdown the moment the next shock hits, hit subscribe. One click, no fluff. Now let's talk about the number that should have been on every screen, 115. In most conditions, that volatility index lives somewhere in a normal band, quiet, manageable, boring. Not today. 115 is rare territory. It's the kind of reading that shows up when the market expects violent movement inside a compressed time window. Movement so aggressive, it can ruin anyone positioned wrong. Here's what makes it even more disturbing. This volatility reading is higher than it was when silver was trading near its recent peak just weeks ago. Translation: the options market is pricing bigger explosions now at lower prices than it priced at the top. That is not what you see when a bull market is over. That is what you see when the market is unstable, and the next move is going to be fast enough to trap both sides. And while everyone's staring at Western spot and futures prints like they're the whole story, there's a split that refuses to close. In the West, silver is sitting around the low 70s on paper. In the East, physical pricing is behaving like it lives in a different universe. Shanghai is holding a premium that isn't fading even while Western paper compresses. That gap matters because it tells you something simple. Real metal isn't following the same script as paper metal. A market can lie with paper for a while. It can't lie forever when physical demand refuses to cooperate. Now zoom out one layer. Metals didn't get slammed in a vacuum. Yesterday's broader market action was the kind of thing you do not see in a calm system. The S&P dumped hard, about 1%, erasing roughly $600 billion in value. Then it reversed and sprinted higher, clawing back and adding even more. The Nasdaq did the same thing, slicing down, then snapping back up like someone yanked the chain. That violent intraday whipsaw isn't healthy price discovery. That's the signature of forced deleveraging. That's what happens when large players are carrying too much exposure. Something goes against them, and they don't get to choose what they sell. They dump what they can dump. The most liquid positions, the easiest exits, the sell first, ask questions later basket. And yes, gold and silver end up in that basket during a real cash crunch. Because when margin calls hit, nobody cares about your long-term thesis. Nobody cares about your charts. Nobody cares about your fundamentals. They care about dollars, right now. This is why you can see stocks down, metals down, and even safe haven behavior delayed or inverted. In a classic fear trade, stocks down often pushes gold up. But in a liquidity squeeze, everything goes down at once because everything becomes collateral. That's when the US dollar index acts like a wrecking ball. It rises, and the rise is not strength. It's the sound of global liquidity tightening. You want the most unsettling part? Banks reached for emergency plumbing. A major signal flashed. Use of the Fed's repo facilities, about $11 billion in total, split between treasuries and mortgage-backed securities. This is not something you usually see in a serene market. This shows up when liquidity is being stressed under the surface, before the headlines catch up. If you're the kind of person who only believes a problem exists when the news says so, you're always late. If you track the system's plumbing, you see the pressure building before the pipe bursts. And this is where the mainstream narrative collapses. They will tell you the metals bull market is finished because prices corrected. They'll point at a sharp drawdown from highs and declare the entire move dead. But a correction can be two different things. It can be a fundamental unwind, or it can be a mechanical liquidation, forced selling that temporarily overrides reality. The pattern we're watching matches the mechanical version, and it's not a mystery. Financial historians mapped this long before social media existed. Crisis sequences have phases: euphoria, peak confidence, internal profit-taking, then panic. The panic phase is where fundamentals become irrelevant for a short window because the system is clearing leverage. That is the window where the market looks irrational. It's not irrational, it's a margin call. Now stack the macro tells on top of each other. Dollar rising, VIX rising, yields falling. That combination is not a cute coincidence. It's a stress cocktail. Rising dollar means tighter global liquidity. Rising VIX means institutions are paying up for protection and risk premium is expanding. Falling yields at the same time means money is running toward treasuries and the bond market is pricing slower growth, or worse. When those three align, it often precedes uglier moves elsewhere. And now you're heading into catalysts. FOMC minutes are about to drop. Then more high-impact data hits Thursday and Friday. These events aren't just information. They're liquidity windows. They're opportunities for positioning, exits, and narrative cover. If you've been watching long enough, you know the routine. The catalyst arrives, volatility spikes, and the big money uses the chaos to do what it was already going to do. So what do you do with this? First, you stop treating volatility as entertainment. Volatility is the market telling you, positioning is crowded, leverage is stressed, someone is trapped. And second, you learn to separate direction from turbulence. A volatility spike does not tell you whether the next move is up or down. It tells you the next move can be big enough to change your account balance before you finish your coffee. Now let's connect this to what silver's chart is actually showing. On the daily chart, there's a level from late December that matters, a prior low that became a reference point. Price recently drove down toward that zone, rated it, and then closed back above it. That kind of move, where price pierces a key low and then snaps back, often functions like a trap. It flushes weak hands and triggers stop losses, then reverses. That pattern can be bullish, not because charts are magic, but because it reveals behavior. It shows where liquidity was sitting, and it shows who got harvested. Right now, the near-term battleground sits roughly in the low 70s, down into the 70 to 72 zone, where price recently bounced. Think of it as a support band, an area where bodies closing below it can signal weakness, and bodies holding above it can signal stabilization. If price holds, and then you see a sharp, decisive move, real displacement, real urgency, it opens the door to a pushback toward mid-70s and higher. But if the market starts closing bodies cleanly below that band, it signals the liquidation wave may not be done, and lower targets come into view. That's the technical frame. Now here's the part most people miss. The options market is not arguing with your favorite influencer. It's not emotional. It's a pricing engine, and it is pricing chaos. A 115 volatility reading means traders are paying for protection and exposure because they expect turbulence inside the next 30 days. That's a short horizon. That's not sometime this decade. That's this month. And you can see why. We're approaching delivery and roll decision points. Open interest, notice days, and the choice between standing for delivery or rolling forward can create stress when positioning is large and liquidity is thin. When that stress is present, the tape gets jumpy. Then you add one more layer. There are players placing asymmetric bets on gold that imply they believe a violent move higher is possible later this year, even after price weakness. Large call structures have been building, positions that don't pay unless gold makes a historically aggressive run. Is that guaranteed? No. But it is information. It tells you at least one deep-pocketed entity believes the upside tail risk is worth paying for. Now a word about the part everyone fights about: manipulation. You do not need conspiracy theories to understand what has already been documented. Major institutions have paid massive penalties for spoofing and precious metals misconduct. Traders have been convicted. That's not a vibe. That's public record. What matters is not arguing about whether bad actors exist. What matters is understanding what bad actors do when the market gives them a window. Like when certain exchanges are closed, liquidity is thinner, or catalysts provide cover. In those windows, paper can push price around far more than it should, for a while. But there's a limit. Because physical demand, premiums, and inventory constraints don't negotiate with paper forever. So when you see East-West premiums holding while Western paper gets smashed, you should not treat it like trivia. You should treat it like a warning. It says, the physical market is not confirming the paper narrative. Now let's talk psychology, because this is where retention gets won or lost. When silver rips, everyone becomes a genius. When silver dumps, everyone becomes a funeral director. The same people who shouted "new era" at the top whisper "it's over" on the first real shakeout. That emotional swing is not a signal, it's the market's job. Bull markets don't move in a straight line. They climb a wall of worry. They punish late buyers, then punish early sellers, then punish anyone who can't handle volatility. And this is why extreme fear, right after a parabolic run and a harsh correction, can be constructive. It can mean the market just cleared out weak positioning. It can mean the next leg is being built on fewer hands, stronger hands. But here's the danger. During an actual liquidity event, the market can overshoot. It can break levels that shouldn't break because forced selling doesn't care. So you must hold two truths at once. 1. The bigger structural thesis doesn't vanish because paper price corrected. 2. In the short term, paper can still do violent damage. This is financial warfare, not a bedtime story. Now let's put the core puzzle on the table, clean and simple. You have a volatility index screaming unstable. You have banks using liquidity plumbing in a way that tends to show up when things are tight. You have the dollar rising while VIX rises and yields fall, the stress combo. You have an equity market printing a historic intraday value swing, the kind that looks like forced liquidation and re-leveraging whiplash. You have a persistent premium in the East even while Western paper sells. You have large option positioning implying tail risk hedging to the upside. And you have major catalysts landing over the next 3 trading days. So the question is not whether volatility is coming. Volatility is already here. The question is, what breaks first? Is it the over-levered equity positioning that can't handle another shock? Is it the confidence in paper price when physical premiums refuse to fade? Is it the illusion that everything is fine because the index closed green? Because that's the trick the market plays in these regimes. It gives you a clean closing print and hides the violence in the intraday tape. Now I want you to notice something. When stress hits, gold and silver getting sold doesn't disprove the bullish case. It often confirms the environment. It confirms that players are liquidating to raise dollars. And if that liquidation exhausts, the rebound can be savage. That's why the market can fall like a trapdoor, and then reverse so violently it feels impossible. Which brings us back to that $600 billion disappearance and reappearance. A healthy market does not vaporize that much value and then refill it like nothing happened. That's not confidence. That's a system slamming between risk on and risk off because someone is forced to move size. And when big money is forced, it leaves footprints. Those footprints are in volatility. Those footprints are in repo usage. Those footprints are in east-west divergence. Those footprints are in support raids and snapback closes. And those footprints are in the emotional whiplash of the crowd. Now here's the part you need to hear if you're watching this because you want clarity. High volatility regimes are designed to exhaust you. They're designed to make you overtrade. They're designed to make you swear off the market right before the next major move. They do it with speed. They do it with noise. They do it with reason that changes every 6 hours. 1 hour it's rates. Next hour it's growth fears. Next hour it's geopolitics. But under the stories, the mechanism is simpler. Leverage is being managed. If you want to survive this phase, you have to stop staring at one candle and making life decisions. You have to use a framework. Support bands, body closes, liquidity raids, displacement, macro stress tells, physical premiums, plumbing signals. When those align, you don't need a loud headline. You already know what kind of market you're in. And you're in a market where the next 30 days are priced to be explosive. So here's what you should be watching as the catalyst hit. Watch whether that low 70s support band holds on body closes. Not wicks, bodies. Watch whether volatility stays elevated or collapses. A collapse can mean the panic is resolving. A persistence can mean the fight is not done. Watch whether the east-west premium compresses or stubbornly remains. A stubborn premium is a pressure gauge. Watch repo usage and liquidity indicators. A one-off isn't proof of doom, but a pattern is a pattern. And watch how the market reacts to the FOMC minutes and the next data releases. Not the numbers, the reaction. Because reaction tells you positioning. Now I'm going to give you the cleanest way to think about this entire situation. In the short run, liquidity rules. In the long run, structure rules. Liquidity can punch structure in the face for a while, but structure has gravity. If you're trying to trade every punch, you're going to get chopped. If you're trying to understand the phase, you can stop being surprised. And if you're here because you want to learn how the machine actually behaves, this is the moment you pay attention. Because the market just told you something with that 115 reading. It told you the next move will not be polite. It told you the range will not be gentle. It told you the crowd will be late. And it told you that the calm story you're being sold is not matching the stress that the pricing engine is buying. Now let me ask you two questions, and I want you to answer them in the comments because your answers tell me whether you're watching the surface or the system. First, what do you think actually broke to create that $600 billion intraday wipeout and reversal? Was it hedge fund leverage, bank liquidity stress, or something else nobody is naming yet? Second, do you think the East-West premium is the real story here, or do you think paper will eventually drag everything back into alignment? Drop your take below. I read the comments, and the sharpest viewers always add the missing piece. And if you want the next update the moment the next shock hits, subscribe to Hidden Power Archives. Short and simple. You'll thank yourself later. Because this is not over. The options market is not pricing a quiet month. The plumbing is not behaving like everything is fine. And the tape is not moving like a healthy market. The chaos isn't the headline. The chaos is the signal. And now you know where to look.